Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing a company that was actually brought up by one of my subscribers. So shout out to Greg Allen who commented on my Foot Locker video saying, "I didn't see a McDonald's on your channel, would love for you to make one, good channel, thanks." And honestly, when I saw this I was actually kind of surprised because I did not realize I never made McDonald's. It's like, how could I not make McDonald's? It is literally an American staple. So we're going to be analyzing this company today and seeing if their fundamentals actually line up with the company's ticker price. So with that said, let's get started with this analysis. Starting off, guys, we are going to come into the dividend summary. McDonald's does pay a dividend at around 2.26%, which ends up being around $1.38 a share for an annual payout of a pretty good decent amount of $5.52. Now the payout ratio in regards to the net income for this dividend is around 56%, which is just barely under my 60% mark. However, we need to take a look at this in regards to the cash flow, because companies don't use their income to pay out dividends, they use their free cash flow. So we're going to take a look at this later to see what their payout ratio in regards to their free cash flow is. The 5-year growth rate on this dividend is pretty good at around 7.85%. There are better ones, but then again, guys, right? McDonald's is a huge corporation with a ton of franchises, right? So also the restaurant business is very tight, at least when it comes to like individual restaurants. Franchises, I'm not sure how tight the margins are. So for all we know, the margins might be okay. Now, they have been able to increase this dividend for 13 consecutive years. Their ex-dividend date actually passed yesterday as of February 28th. Payout date is in about 15 days, March 15th, and they pay their dividends quarterly. Now let's come over here to the spreadsheet. But before we get started with this, let me just all remind you to, of course, like, subscribe, comment. Really does help out with the algorithm on YouTube. And if you want this calculator, I have it available for free. All I'm asking is for support on my channel. That's about it. Now, ticker symbol of MCD, McDonald's, McD's, market cap of $178.2 billion, PE of around 23.88, let's just say 24. Now, what this is telling me is that based on their earnings, that they might be a little bit overpriced. With the current share price of $239.63, it might be overpriced, right? It might be overpriced according to their earnings. We need to take a look at their other fundamentals and come up with a more accurate share price. Now, as I said, their annual dividends is around $5.52. The amount of shares outstanding that they have multiplied by this dividend tells you how much they pay out in dividends every single year. And according to this, they pay out around $4 billion in dividends every single year. And now after this is paid, in relationship to the 5-year average free cash flow, they have left around $926 million. So taking a look at the payout ratio in regards to the free cash flow, this comes out to be 81.74%, which is significantly higher than my 60% average that I like to aim for. Now, they can absolutely afford this dividend based off of these numbers. However, they are cutting it really close, guys. $4 billion is a whole lot, especially when they only have left around $926 million. Now let's come over here to the actual fundamentals, starting off with net income 5 years ago of $5.2 billion to 1 year ago of $7.5 billion, which is a good steady increase of 45%. Now, the elephant in the room here is 2 years ago, they went down to $4.7 billion from the prior $6 billion. Now, if you'd guessed that the reason for this drop was COVID related, well, you'd be correct. This actual drop was taken from December 2020. And we all know what happened the year of 2020, right? COVID hit. Restaurants were really damaged because of the fact that nobody was going out. Now, McDonald's was a little bit insulated from this because they have a drive-through. However, they did get a hit, and we can see that in their net income. So be prepared to see a drop when it comes to their 2-year-ago metric. Next, we got the free cash flow, the lifeblood of the company. It is cash from operations minus your capital expenditures. Capital expenditures tend to be negative, so we just add them. 5 years ago of $3.7 billion to 1 year ago of $7 billion, which actually ends up being 92% increase with an average 5-year free cash flow of $5.1 billion. Now, the same thing we saw with the net income we see in the free cash flow. 2 years ago, boom, they went down. Again, COVID related, not really much of an issue. Therefore, I honestly foresee that they might be able to increase their cash flow into the future as demand ramps up, especially as food prices get even higher. Next, we got the revenue, and actually rather surprising. I was not expecting this. 5 years ago of $22.8 billion to 1 year ago of $23.2 billion, which is a really small increase of around 1.76%. Now, as you can see right here, they were pretty much flat from 5 years ago to 3 years ago. They had the little dip in 2020 as we have been seeing, and well, 1 year ago, they pretty much just went up again to where they were in the prior years before 2020. In my personal opinion, I consider this as a flat metric, which is actually really surprising because I would think that McDonald's would be making a whole lot more revenue than this. Next, we got the total assets minus the total liabilities. This tells you if they were to liquidate all of their assets, would they be able to cover their liabilities, therefore allowing you to see if they are able to survive a recession. Now, currently, they have about $3.1 billion in assets minus liabilities, meaning if they were to liquidate all their assets and pay off all their liabilities, they would still be left with around $3 billion. Big elephant in the room here is, of course, 2 years ago, they were at $62 million, and 3 years ago, negative $63 million. Now, the 2 year ago metric can be explained, again, COVID. However, guys, I have no idea what caused this negative $63 million in the total assets minus the total liabilities 3 years ago. I have no clue. But nonetheless, currently they are able to afford it. The average assets is around $5.6 billion, the average total liabilities is around $4 billion, and doing the average assets minus the average liabilities, we get around $1.6 billion. Now let's take a look at the shares outstanding, and this is actually a metric that I really want to pay attention to here in McDonald's because this one strictly correlates to their dividend. This tells you whether or not the company is diluting you as the investor. You want this number to be going down, not up. Currently, McDonald's, they're buying back a reasonable amount of shares from 5 years ago of around 794 million shares to today of 751.6 million shares. Now, on the 5 year, guys, this is a decrease of around 5.35%. However, from the previous to the current year, it is an increase of 0.83%. This previous to current is not from 1 year ago to today, it is from 2 years ago to 1 year ago. For some reason, Seeking Alpha has not updated the current year's numbers, which is probably 2021, or maybe they even didn't buy back shares for all we know, right? Nonetheless, from 2 years ago to 1 year ago, they did increase it a little bit. Now, the reason why I wanted to pay a really close attention to this is because this is what's going to tell you whether or not they're going to be able to afford their dividend. When a company buys back shares, that means that the percent of the shares that they bought back are no longer required to pay this dividend out, because if they hold it, well, if they pay themselves a dividend, it's as if they're giving themselves money, right? So obviously they're not going to issue a dividend on the shares that they hold, meaning that the dividend amount that they pay out every single year, if they keep buying back shares, will actually decrease, making their payout ratio in regards to the free cash flow actually come down, making it significantly better for us, seeing that they are able to not only afford it better and also increase it in the future. And lastly, we got the cash and equivalents. Currently, guys, they have around $4.71 billion in cash and equivalents with an average cash around $2.8 billion. Now let's make some assumptions, low, medium, high, using 3 different factors: growth, projected share buyback, and required rate of return. For the required rate of return, I'm going to keep it the same, 10% across the board to match the S&P 500. Now, for the low assumption, I'm going to assume a growth around 13%. For the projected share buyback, I'm going to say 3%. This comes out to be a target share price not adjusting for debt of $154.17. For the median assumption, I'm going to assume a growth of 14%, projected share buyback of 4%. We get a target share price of $164.28. And for the high assumption, a growth of 15%, with a projected share buyback of 5%, we get $175.07. Now we need to adjust for debt. As you can see, this number comes down significantly. This means that the amount of debt that they have exceeds the amount of cash they have on hand. So adding this to the current market cap that the calculator comes up with, the share price comes down from $154 to $90.12 for the low assumption. For the median assumption, it is $98.21. And for the high assumption, we get $106.89. Now, me personally, I like to add a margin of safety because the more you pay for something today, guys, the less returns you're going to have in the future. So you don't want to overpay for something. Now, in adding this margin of safety for the low assumption, we would like to buy between $76.60 all the way up to $85.62. For the median assumption, we would like to buy between $83 all the way up to $93. And for the high assumption, we would like to buy between $91 to $101.55. Now, with the current share price, guys, of $239.63, it's pretty much telling you that this company does need to fall a lot. Assuming that you don't even want to go for the target share price, adjusting for debt, we're still at 175 with the highest, peachiest assumption, right? It needs to fall by a significant amount. And, well, in my personal opinion, this is kind of justifiable, right? They do have a lot of good metrics, don't get me wrong. However, when it comes to their shares outstanding, they could do a little bit better. And when it comes to their assets and liabilities, it is a little bit iffy that they went negative 3 years ago, which I have no explanation for, right? 2 years ago, it makes sense. 3 years ago, no idea. But then again, I always say this every single time. I do not tell you what to buy. I am giving you the raw numbers that anybody could get. It's available for free on Seeking Alpha. Literally, anybody could get it. And I give you my assumptions as to what I would buy this company if I were looking for it to buy it. If you do not agree with my assumptions, which hopefully you don't agree with my assumptions, I highly suggest you get this calculator. As I said earlier, I have it for free. Anybody can have it. All I ask for in return, guys, is like, subscribe, comment. The calculator is available in my discounted free cash flow calculator video. The updated one is for free. Make a copy. Boom. You make your own assumptions. All I ask for in return, guys, is like, subscribe, comment, share, and hit that bell. All in all, when it comes to McDonald's, this is actually a company I considered adding to my dividend portfolio. However, looking at it now, I really would like for this payout ratio to come down a significant amount, probably to like 70 or 75%, right? Between that range. That's still above what I like. However, it is better than 81.74. Now, something I would also like to see is them fixing the whole shares outstanding. I would prefer if they would consistently be going down and not being all over the place when it comes to their shares outstanding, right? And lastly, I would like to get their assets and liabilities under control as well. Aside from that, pretty much a solid company through and through. Again, they do not have a lot of money left in order to keep increasing this dividend into the future unless they buy back shares. But that pretty much does it for this episode. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble. Or in addition to my stock analysis videos and crypto videos, you'll find exclusives as well. In regards to Rumble and YouTube and Odyssey, I have a Let's Play channel called Fatal Plays. Also link in the description, where I'm currently playing through Pokemon Legends Arceus, so if you want to catch that, make sure to follow me there. With that said, peace out, and be on the lookout for the next stock analysis videos. And before I go, if you guys have any recommendations for me to do a stock, please comment below. I'm more than happy to take recommendations, right? I'm more than happy to. So with that said, peace out, and be on the lookout for the next stock analysis video.